Hi, a very good afternoon, everyone. Welcome to our webinar. So to start off with, while we wait for more participants to enter, we'll play a video, short video.
This is prime real estate. Nice location, good cash flow, a property you'd love to own. The problem? High capital requirement. Very high. With Fraxtor, you can still directly own it without breaking the bank. Here's how it works. We source hundreds of deals across Singapore, Germany, Australia, and the UK. Using over 100 plus years of combined real estate investing experience and due diligence to select major opportunities in niche markets. We use a fully audited private blockchain to create fractional shares from these amazing properties for liquid, fast, and global access on the Fraxtor platform. Once your account is approved and funded, you can invest in real estate assets in seconds. So if you're ready to take real estate into your own hands, sign up on Fraxtor today.
Okay, hi everyone. I'm Oliver, the co-founder of Fraxtor, and it's my honor to host this webinar. Fraxtor is a blockchain-enabled platform that allows investors to co-invest in real estate projects and funds. We provide investors access to the global real estate market through digitalized securities offered on our platform to provide our investors with a hassle-free investment process. Minimum investment quantum can start from as low as 20,000 Singapore dollars. Unfortunately, we are only allowed to onboard accredited investors and institutional investors. Joining me in this webinar is Steve Douglas. Steve is the co-founder and managing director of Australasian Taxation Services and chairman of SMATS Services Private Limited. His area of taxation specialization includes non-resident property investors, migration, and expat taxation planning. He's a regular presenter on taxation matters affecting property investors, expats, and intended immigrants. Steve has delivered seminars on behalf of many industrial organizations and developers, including the Real Estate Institute of Western Australia and the Australian Chamber of Commerce, Hong Kong. He wrote the expat tax planning book, The Aussie Expat, The Luckiest Person on Earth, which has sold over 10,000 copies, as well as numerous reports and training material. In addition, he has been active in submissions to government on tax issues affecting property investors and expats. Steve has been featured in articles by the Singapore Business Times, South China Morning Post, Australian Entrepreneur Magazine, Benchmark, Western Australian Property and Investment, and Property Link Magazine. Steve began his career in Ernst & Young in 1984 and established a private taxation practice in 1988, specializing in small business taxation and management. He is a fellow of the Taxation Institute of Australia and a registered tax agent. In 2009, Steve was recognized as one of the leading 50 Australians in Asia by Advance and invited to participate in Advance Asia 50 Summit in 2010 and was awarded the Singapore AusCharm Entrepreneur Award. And in 2017, Steve was the Finder's Expatrineer Awardee 2017. Okay, so before we begin the webinar, a little bit of a disclaimer. So this presentation is only for educational purposes. You're not to rely on this to make any of your own investment choices. And a little bit about Fraxtor. So Fraxtor is an online real estate co-investment platform that allows accredited investors to invest alongside industry veterans at a smaller quantum. The key personnel, as shown, Rachel Teo, I think most of you are familiar with. She's a real estate veteran. Her family has been in the real estate development market for more than 50 years. Myself, I'm the CEO of Fraxtor. I have more than 10 years experience managing real estate investments. And we have Joyce Ng, who is our Chief Operating Officer. She was an ex-banker and is currently handling our operations team as well as compliance. We have Marcelo as our CTO. He has a vast experience in developing technology and applications for financial institutions, including Barclays Bank. The investment focus of Fraxtor is widespread. We focus on products from with core risk all the way up to opportunistic risk profiles. And we have a very simple investment process. Onboarding can be done via facial recognition or MyInfo for Singapore residents. After the onboarding process is done, you can simply subscribe and fund your account and own the digital securities for that particular project. And then after which you can earn periodic dividends and long-term capital gains. Before we begin, I'd like to launch a poll, so to get a rough understanding of who we are talking to today. So I'll leave the poll running for about 45 seconds. You can take your time to look through the questions and answer those. Okay, so I think we've got the poll results. I'm going to share the results with Steve and the attendees. So I think it's quite a mixed audience today. So we're varying experience in terms of the investing in the Australian real estate market. So over the next 5 years, how do you think Australian property market will perform? I think it's also very mixed. Large proportion, 43% says it's going to be strong. 17% say it's going to be weak, and 40% say neutral. And yeah, that's good. 73% of the attendees have indicated that they are interested to invest in Australia. So with that, I'm going to hand over to Steve to carry on his presentation, and then we'll stop after that for a Q&A session. Okay, Steve, I'll get you to share your screen.
Thank you, Oliver. It's a pleasure to be with everyone today. Delivering obviously remotely. I'm normally a Singaporean. I'm usually up there, face to face with you guys. But obviously with COVID, I've been trapped down in Australia for the last 8 months or so. So time seems to be flying by, and not sure when I'll be back in Singapore. Probably once travel bubbles start opening up and things like that. But we're certainly living in unusual times. So quite opportune to obviously have this this presentation and talk about the Australian property market. It was great to see so many of you are keeping your faith in the Australian property market and still interested. So that's terrific. And hopefully today I'm going to help you, understand why that faith is there, and whether your faith is warranted indeed. So we'll get stuck into it. And of course, what I need to start with, same as with Oliver, is also a disclaimer. Again, these are basically my own opinions. Even though I've been talking about this for so long, I still have to put a disclaimer just in case. So please make sure if you want any specific advice, reach out. We're always happy to help, no problems at all. But just remember, this is a very general seminar. There's never enough time to be too detailed, but we're there for you if you need any personal assistance. I thought I'd start off, just one second. Where am I? I'll just start off with going through, obviously, the COVID issues in Australia. And I did a quick bit of research looking around for countries that had helped out property markets during COVID, and Australia was pretty much the only one. And of course, it needed to do it because there was lots of concern and worry when COVID came to Australia's shores, as it's still going rampantly around the world. But of course, COVID had a lot of impact. And I think it's fair to say that this is not just an Australian issue, but a global issue. The impact on confidence is probably the biggest thing. Every market, lives and dies on confidence. And moving into an era of unpredictability of not just impact, but also duration. That really is something that we're all still coming to terms with. And you see, COVID started rolling out globally in February, and here we are in mid-October, late October, and there's still no real, definite horizon as to when we're going to start seeing change and recover and rebuild. Until the vaccine is probably released, that's not going to be there. We have seen owner-occupier activity on the rise, and part of that might be ironically because people are being locked up at various places. And so they're probably taking the psychological decision to say, look, if I'm going to be locked up, I might as well be in somewhere nice, and I might as well focus on a nice home now because travel may not be as easy in the future, etc. In Australia in particular, we got very, very hard hit with both short-term and student accommodation. And that's especially true in Melbourne, which was where the dominance of that market existed. Melbourne, of course, has got into its second wave. The rest of Australia only had a very initial lockdown period and then has moved to basic normality. But in Melbourne, they didn't get it quite right. COVID got back in the community and they're still in lockdown as we speak today. But their market in Melbourne was very, very dominated by tourism and also student accommodation, because there's a lot of smaller apartments there, what we call stops, small, tall and overpriced, which are well suited to students and tourists, but not so well suited to the usual population. So that's continued to be impacted greatly there. We're seeing affordability being an issue. A lot of people obviously went into lockdown, either lost their job, were put on furlough or whatever. The Australian government was very quick to intervene there and ensure that no one could be thrown out of their property if they were directly impacted by COVID, and I'll show you some of their measures shortly. And of course, access for day-to-day transactions in property markets around the world have been severely restricted. Obviously, you can't have home opens to the same extent that you would. Everything's moving online. That was probably a little bit inevitable, a little bit necessary, but it's probably modernized the industry very quick. What Australia did very well, again, through initiative of the government, was to offer anyone that was in COVID issues financially to allow them to defer their loan repayments for up to 6 months, so they didn't have any cash flow pressure if they were lost earnings or lost rent as a result of COVID. And of course, we're now starting to get used to living with COVID, and we're seeing how that exists in our community, how it can be managed in our community. And I think Australia has been the poster child. I mean, we've done it right everywhere except Victoria. But Victoria doing it wrong isn't necessarily a bad thing. It has taught us many lessons. The key thing is obviously to control your borders, control your quarantine, test everyone that's coming in so that there's not a unmanageable release of the virus into the general population. And Australia being an island, albeit a very, very large one, has been fantastic in being able to deal with that, except for the brief run in Melbourne where they didn't manage their quarantine very well at all and are now paying the price for that. Now we're seeing, we're seeing some of the issues that the government did. And again, Australian government was quite unique around the world in being the only one that provided direct relief and stimulus into the property market to protect it. And that's probably because of our caring nature. We very much care about the community in Australia. We're very supportive. There's been great financial packages in terms of income support, to keep people employed, even during the periods of lockdown initially and subsequently. There's still ongoing business relief, but property got its own dose of support packages. And again, if you look around the world, no one can match this. So this is one of the great reasons that I'm confident the Australian property market is going to probably be one of the best performers throughout this period, however long it may be, as we move through COVID into the new generation of how we live. Federally, the governments, said that you could not, force somebody out if they couldn't pay the rent. They encouraged landlords. They didn't legislate it. They encouraged landlords to be very flexible and allow for either rent deferrals or rent reductions. But there was no force to do so. So the community gathered around and self-regulated, which was fantastic. The government only regulated to the point where you could not evict someone, but they let them self-manage the financial impact. there was no ability for any landlord to terminate someone's lease during COVID, so no one could be thrust out into the street in a potentially dangerous environment, which was fantastic. And they provided $90 billion worth of additional government funding to the banks to fully fund any deferral loan programs going on. So the government was very, very intent to say, okay, if you've got lower wages, no wages, then don't worry about making your payments for 6 months. Now, they didn't give you a waiver. You still had that cost, but it was pushed down the line until you were in a stronger financial position. That's now all starting to come out. And the great thing is we're seeing the statistics come back that very few people are still in stress over that, except, of course, in Melbourne, where there's still in a case of lockdown. Now, the state governments also stepped up to the mark, giving 25% discounts pretty much across the board on land tax, and a few of the states also, provided a few, rent subsidies to help people in extreme problems, pay their rent during that, worst period. Now, importantly, though, these were not just blanket decisions. You had to absolutely prove that you were directly impacted by COVID in order to qualify. Now, impacted meant you either lost your job, reduced your income, or physically contracted the virus. So you couldn't just say, oh, look, I've heard that I could do this, I think I'll take advantage. You had to properly be impacted. So we are in a rental business. We were reviewing people's employment records and their financial standing to make sure that they qualified. And that kept things sensible and minimized abuse, which was fantastic. What we have seen is COVID is not the only thing that is impacting property market in Australia. We had influences going on before COVID, during COVID, and of course, post-COVID. So just to give you an idea of just the normal influences that we have, and that is obviously confidence being number one. Now, it took a while for confidence to come back. There was obviously that initial fear and panic. The government initiatives have certainly put a lot of air back in the tyres, so that was fantastic. And one of the other things the government has done is to not only stimulate the existing housing market, but build upon what was going on and protect the construction industry. We've now got a raft of incentives for first home buyers and owner-occupier builders federally, and then a lot of additional programs at state level, for new construction to support the building industry. Importantly, in Australia, the building industry was one of those that did not have to go into full lockdown. So even at the height of Australia's slowdown, the construction industry was allowed to proceed as normal throughout the COVID first lockdown phase, which was very, very important. Now, we've seen also a byproduct being a boom in renovation, particularly as people were stuck home for prolonged periods. I suppose when you're stuck at home and you've got nothing else to do, you start looking around and you realise that there's a bit of a crack there and the lawn's looking a bit sad and I could do with a bit of extra room. So all of a sudden we went into a renovation boom in Australia over the last 6 months. And the government also allowed some of those federal incentives to be used on renovation as well as new build. One of the big things that happened was Australian expatriates, which are a reasonable part of our population. About 1 million expatriates always live outside of Australia at any one time. A whole flood of them came back. They were told the borders were going to close. They were told, hurry back. And approximately 300,000 came back, according to the Department of Foreign Affairs, which is a huge amount of number. The traditional average that comes in and out is about 80,000 to 100,000 leave, 80,000 to 100,000 come back. So we almost saw a tripling of that inflow. Now that's a massive thing because many of them had lost their jobs and have decided that they might as well relocate permanently back to Australia, which has been a new boost to our population, which I'll talk about shortly. But of course, migration has taken the opposite effect, where the government said, okay, unless you have PR or citizenship, you cannot come into Australia at the moment. Now, they're not looking to relax that restriction for some time, probably not till April, June next financial year. So we're seeing a pushback where usually we get 150 to 200,000 migrants arriving. That's certainly slowed down. Now, it won't go to zero because a lot of the migrants that come to Australia take 2, 3, 4 years for that to occur, from the time they get granted their PR status. Now, they can come back now, but of course there's fear of movement. It's not as easy to get flights because the planes aren't flying. There's quotas in Australia. So migration is basically on pause. a lot of people are out there, both Australians and intended Australians, are stuck in other countries. And that's getting a lot of headlines down in Australia about how we've abandoned our expat community abroad. So the government's organising some flights at the moment, looking at quarantining special provisions to bring back those stranded. But migration is likely to stay on pause for another 18 months to 2 years. So they're literally going to be very, very hard if you hadn't already got your PR to get your PR in Australia at the moment. The other thing that's happened in the property market over the last 5 odd years is the entry costs, if you're a foreigner, have been going up and up. There's a new foreign buyer fee of 7 to 8% in each state. And that's a state charge, not federal, but that's a very, very expensive exercise. And then there's already a high cost with what we call stamp duty in Australia, where there's about a 6% transaction fee on most property that you buy. So the combination of the two means it's a 14% additional cost of acquisition. That certainly slowed Australia, which was experiencing up till about 2017 a record level of foreign investment into the new property market. Now, a lot of people forget that in Australia, to buy a property in Australia, if you are a foreigner, you have to buy a brand new property. And that was always good for our economy because it stimulated construction. But with these additional costs, that has slowed dramatically. It went down 70 odd %. Still high by our traditional levels, but a long way off the peak in about 2017. The other thing that's really going on in Australia that is extremely unusual for us is interest rates. Now, Australia has never been a low interest rate country, but during COVID, they've shifted the official rate down to just 0.25%. That's the lowest it's ever been. At a borrowing level, that's about a 2.25% home loan rate for an owner occupier. Now, again, that's a big margin. The banks are very happy, but for us as Australians, that is incredibly cheap. We're traditionally used to 4, 5, 6% interest rate. So this is the first time we've been in a sub 3% market. And of course, that's taking a lot of pressure off the market and helping people with their affordability at a time when affordability is potentially an issue. Ironically, even though the interest rates are at record lows, it's never been harder to get a loan. So we've had a situation where it's a little bit of a quandary where, hey, the interest rate is fantastic, but sorry, you don't qualify. Now, the government announced in the budget just recently that they're going to relax those rules. So it'll be interesting if that means foreigners can get better access to finance, but it certainly is difficult for foreigners. It's not that easy for expatriates, and even for people in Australia, it hasn't been that easy. But we'll see what happens there. And of course, the main thing that always affects the market, and not just in Australia, but globally, and I always have to remind people because we seem to forget it, is supply and demand is still the most important and dominant force in any property market. Too much supply, not enough demand is never good. It's going to mean flat or falling prices. Too much demand, not enough supply is good if you already own because it's likely to push prices up. But what you have to do is look at where that supply and demand is and make sure you're satisfied, because it's not just a big level, it's got to be at the micro level as well. So they're the key influences that affect the Australian property market and pretty much mirror themselves on many global markets around the world. To show you the importance of population growth, Australia has traditionally been one of the highest population growths in the Western world, traditionally running out at about 1.6% per annum. Now, that's usually been about half net migration and half net births, so births over deaths. Now, they're expecting next year, under the recent budget, for that to fall from 1.6% down to 0.2% growth, and in 21-22, 0.4%. That's a massive contraction in population growth. And population growth, I've said for many, many years, is the single most dominant force required for property price growth. If you've got more population, then you can support new construction and you can create natural demand to satisfy increasing supply in all areas. Now, one of the things that's interesting is you'll see there that I'm not convinced that the population growth forecasts are right. And one of the reasons I say there is net overseas migration in calendar 2020 was 271,000. And that was the result of so many of those expats returning. That's well in excess of its traditional average. You can see 1920, it was about 154,000. So it went from 154 for a year up to 270 as a result of COVID. Now, you can see in 2021 and 21-22, the Treasury is forecasting that net migration is going to be minus. So they're actually expecting more people to leave than arrive. Now, I'm not convinced this is going to be the case, because I believe this is predicated on the assumption that a lot of the expatriates that came back will actually leave as soon as they can. But the problem we have on a global basis is a lot of the jobs those expats had are not going to return for quite a while. We're seeing the airline industry, the hospitality and trade being massively savaged on a global scale and with no real change in sight. So many of those Aussies were in the hotel industry, were in aviation, and are now going to have prolonged periods before those sorts of jobs might reinvent themselves or return. So I'm probably differing in the opinion to the Treasury, where I think they're going to see that 2021, 21, 22 might be positive or flat, because I don't think those expats will actually leave. Not at least then, maybe later. Now they're saying they're going to kick it back up to 22, 23 to 95,000, and then back to 200,000 in 23, 24 when everybody starts coming in. But you can see, I think we're going to have a lot stronger population growth during those periods. But time will tell who's right, me or Treasury. But interestingly, with that influx of expatriates, that's one of the things that has been supporting and strengthening the property market in Australia during this confusion time of the COVID. Now, if we have a look at the long-term average, Australia's been very, very consistent. Now, if you can see in March of 2020, we are seeing a small dip off as a result of COVID. But you might notice that in March of 2019, there was quite a larger dip off. You can see the Sydney prices went from about 1.2 million all the way back to just over $1 million. Now, this is the great irony of the modern age. There was nothing going on in the Australian property market except for the fact that there was a federal election. The opposition leader came out and said he was going to make all sorts of changes to tax regime and particularly property market taxation. He was going to remove negative gearing and a few other things. So we see the irony was Australians were far more concerned on a financial issue, being the election, where prices dropped, 3, 4, 5%, rather than COVID being a global pandemic. And this is the great irony in life. We're always more worried about money than health, apparently. So, it's interesting that the COVID crash is nowhere near anywhere, to what it was for what I call the Bill Shorten crash. And it's obviously those support packages the government, brought in. It's also the interest rate reduction. And it's also the fact that people think we might as well bunker down. It's not that they can rotate houses. And one of the things many people forget is Australia has approximately a 70% owner-occupier ratio, which again is one of the highest in the world. To give you an idea of how that all looks, is the June 20 figures, according to the REIA, did see virtually every state go into the red. So as you can imagine, COVID kicked in around February, March. First level of lockdowns kicked in during that March, April period. And you can see that across the board in Australia, there was that quarterly change. 2% nationally, 2% in Sydney, 3.5% in Melbourne, 0.9% Brisbane, 1% Perth. That's not surprising given the worry. The interesting thing, though, is that if you had been reading the newspapers along that time, everyone was predicting 20, 30% falls in property values. Everyone except me. So we did a COVID presentation on the property market saying why we didn't think the property market would have a COVID crash. We looked at things like the support packages, like the inflow of expatriates, and we're very, very confident to say that we didn't feel that there'd be much impact at all. And we turned out to be correct so far. Now we're seeing that, over year to year, Sydney did 5.9 year-to-year growth, but the anecdotal evidence since June is that most markets are going pretty well. Now, Melbourne obviously is still in a little bit of concern for two reasons. One, they've had their second wave of COVID, and two, because they had an overabundance of inferior stock, these stops that I talk about, these small, tall and overpriced apartments in particular in the city. Now, they're now having real trouble to get occupancy. The students aren't there, the tourists aren't there. So it's very, very hard to get your property rented in Melbourne right now if it's an undesirable, smaller style property. but everywhere else is doing quite well, as you'll see from the growth stats. And Australia has been very resilient through all these things, and the fact that it's a very genuine owner-occupier dominated market. To give you some backup on there, here's the vacancy, and you can see Sydney has crept up to 4%. Now, that's gone up by 0.8 on the year, but 0.9 in the quarter. Now, that's largely because a lot of supply has come onto the market. Now, Sydney has been in a housing boom for the last 3 to 4 years, and as a result, there's been a lot of developer new build activity, and that's now coming in. And of course, there's not as many people to suck that up, so it's gone up a little bit. But Melbourne's still sitting there, even with the large amount of oversupply, at 2.8% vacancy. It's gone up 0.6 year on year. So it was 2.2 before COVID. It's moved to 2.8. But that's still extremely low by global standards. Brisbane's sitting at 2.6, and there's Perth. It's now the lowest in Australia at 2%. In fact, I just was reading, listening to the stats today. It's officially moved under 1% now, the vacancy in Perth. That's a massive contraction, because if you've been following the market the last few years, Perth had crept up to a 5% vacancy only about 2 or 3 years ago. So to go from 5% to 2% is a massive contraction in vacancy in a very, very short period of time. And this is why I'm quite bullish on Perth, because the fundamentals there are extremely strong. But across Australia, you can see that that vacancy gives you great confidence in decision making as an investor. If you don't have much vacancy, which Australia traditionally doesn't, then you know you're in a balanced and stable market. And that's really the key. Now, if we had seen this blow out, then you would certainly be worried. Now, you can see rents have not increased year on year. Now, the fact is they actually did go up prior to COVID, but with COVID, we've seen them come back a bit. So that actually wiped out the rent increases that we were seeing before COVID came along. But we're seeing equilibrium stay intact mainly across Australia. Of course, Melbourne, being on the second wave, does have differences, and that's just a time lag thing now. But Perth is now starting to expand its rent value because the vacancy rate is so low now. To give you an idea of the different options you have in the Australian property market, I've just put this chart together. It's fairly large, but there's lots of choices you have. And of course, you could be a direct investor or an indirect investor. And I've tried to segregate the markets into all the different areas for you. So when we talk about direct investment, that's obviously you buying a property. And there's two areas of market. It's very, very important you understand this if you are looking to invest in Australia, because one of them is likely to be disappointing. The other is likely to be quite appreciating. So what we call stops and standards. So small, tall and overpriced, or very simple property that is easily replicated, is probably a market that I would be nervous or cautious to invest in. The risk there to me is very, very high for a couple of reasons. They're not generally livable, and also the fact that they're very easy duplicatable. So you're going to end up with a lot of supply and not a high amount of demand. In Australia, we have a very high average weekly wage. So everyone has an extremely good lifestyle. They therefore can be selective with the accommodation they choose, and they're not going to necessarily just pay to have basic accommodation. They're quite fussy when it comes down to it. Now, the lending is equal on both of the risky asset and the quality, but the quality market has much less supply, and therefore the risk to me is much lower. You want to have it there because that's where the most demand is. And if you have more demand and less supply, they're the fundamentals that you want to push prices up. Liquidity on stops is very, very difficult. It's very hard to sell, particularly at the moment, where we're seeing good rotation in the quality end of the market. And if you buy off the plan, either an apartment or a house or a townhouse that's before construction, then you're going to get building incentives at the moment. You're going to get some good areas. You're going to get some very good incentives. In WA, they're giving you a 75% discount on stamp duty, etc. So they're worth considering and sussing out. One of the disadvantages of off the plan is obviously you can only buy where development is occurring. So you can't always be in the area you want, but you certainly want to check that out. The entry costs, are about 4 to 6% being that stamp duty. Again, WA offering a 75% discount. You've obviously got the foreign buyer fees. So if you are not an Australian citizen, you will have to pay, or permanent resident, you'll have to pay a 7 to 8% entry fee. In New South Wales, even if you are a permanent resident visa holder, you still have to pay the foreign buyer's fee if you haven't lived in Australia for more than half the year. So you have to be very mindful that even if you're a PR and you go, oh, well, I'll just go and buy a property in Sydney, that you will still be hit with that foreign buyer fee if you haven't been in the country most of that year. Now, land tax is payable if you're a direct owner. That's a state government charge. And what we've seen again is the states have been quite mischievous in the last few years, putting a premium on foreign owners. Again, permanent resident visa holder or citizen in all but New South Wales are not subject to that premium. It's just standard rates. And the more property you own, the higher that land tax becomes. But in New South Wales, even if you are a permanent resident visa holder, you still get charged the foreign surcharge, which is very, very expensive. Now, the income you get from a property in Australia at the moment is usually about 2 to 3% net rent after ownership costs. So that's after your maintenance, your property management fees, your rates and taxes, things like that. So that's about the income you would expect, which with interest rates being so cheap at the moment is not unattractive anymore. And then capital gains tax, I've just noted there with stops and standard stock properties, I believe that there's a very, very low likelihood of capital gain. Okay, so you need to be very, very careful what you're buying. If it's not large, livable and nice, be very, very careful to step up and buy that. And when I say large, I mean, for a 1-bedroom apartment, it should really be more than 50 square meters internal. For a 2-bedroom apartment, ideally no less than 65 square meters and hopefully 70. And for a 3-bedroom, absolutely no less than 100 to 110 square meters internal. If you get smaller than that, it may be large considered international scale some places, but not in Australia. So you'll have difficulty with renting, getting a premium, and more particularly very difficult to sell. If you've got a nice house, the rental on a house and an apartment are not that much different these days. Usually the rent is more on an apartment, but the body corporate fees are higher. So it sort of balances out so they're about the same. And there's usually a misconception that people think it's harder to rent a house than an apartment. That is not the case. They're equally easy. But on the quality end of the market, it's highly likely that you would be expecting 3 to 6% per annum gains. And if you're lucky, maybe even a bit more. Now, I think Westpac came out and they're quite bullish on where the market will go, predicting 80% growth over the next 2-3 years. So that's consistent to what I'm predicting. So direct, you can go in with, I think, great confidence if you buy a nice property in a nice area that you would believe it to be nice to live in. But if you go into the stock market, if you go into the basic market, be very, very careful not to be buying somebody else's mistake. Even if you buy it at what is perceived to be a great price, it could end up being a very unflattering investment for you. Now, the other alternative you've got is the new age, and that's the fractional ownership. So buying as an indirect investor. Now, the advantages of that are many at the moment. Obviously, straight off the bat, if you go and be a part owner rather than a full owner, it's a lot less risk because of the fact you're sharing that risk. You might be able to buy a better asset, a more valuable asset. So that becomes pretty good. But importantly, the other thing is that you probably don't have to worry about finance because that's going to be handled by the entity or the group that buys the property that you participate in, not yourself. So you just put in whatever cash you can afford and it becomes part of the pool. It's relatively liquid. Most fractional ownership allow you to buy and sell under certain rules. And you've got a large choice that will still get the incentives if it goes off plan. Everything else is internal. The entry costs, not yours. They belong to the entity that you participated in. The foreign buyer fees are actually zero, even if you're a foreign buyer, provided that the majority of the ownership is still Australian based. So as long as 51% of the participants in that fractional structure are Australian citizens or PR, there is no foreign buyer fee. So as a foreign buyer, if you do that, there's a massive saving to you, just on that alone. The land tax is an internal cost not borne by you, but you don't lose much in income or capital gains tax potential. You're picking up 1 to 2% income, 3 to 6% capital gains too. And if there is funding in there, you can leverage that up a bit. Now, you can also go to what we call active debt, which is where you lend money into a project and not become an owner, but become a debt instrument holder, usually secured. So you're protected by a mortgage. You don't have to worry about the risk. So the risk is low to medium. You don't have to worry about, getting lending because you are the bank. You're the one doing the lending. The liquidity is good. It's set for a certain period, usually in the medium to short term. And then you don't have to worry about thinking about incentives. You're just being a borrower. But you can see the reward for you comes in the income. You can pick up between 6 and 14% usually as a mortgage-backed security on a 1 to 3 year term usually. So that becomes very, very attractive. Now, if you are living overseas in Singapore, the only income tax that you pay on that 6 or 14% is a flat 10% withholding tax. So that becomes very attractive because if you earn profits on rents, then your tax rate starts at 32.5%. So that becomes attractive as well. And then the last column I've got there is what we call active equity, where you actually become part of the development group. So you could go in, contribute some cash and say, okay, I want to be part of the overall project. Let me be an equity participant. The risk of that is obviously a lot higher because you are in the active pool. You are the group that is buying the land, value adding the land, selling the land. So you never know quite how much you're going to make. Lending again is handled internally. You don't get your money back until the project is completed. So you have to be mindful of how long that is and if that suits with your timeframes. But all the other costs are internal. And usually you wouldn't go into a project unless you were going to make about 15% or greater. So if you're dealing with a good company that's reputable, their due diligence would make sure that there was a very realistic assumption of achieving a 15% per annum target. So it should be the highest performing asset out of those groups in theory. And the reason, of course, is because it is a higher risk. And it's the old adage, the higher the risk, the higher a return. Now, risk is not necessarily bad because it does make you money, but it's very, very important that you've got confidence in whoever is managing that risk on your behalf. And that's very, very critical. And that's where obviously do your research, make sure they've got proven track record, history, good team, good projects, have a look at what's going on and participate, after, full investigation. So you've got lots of choices there, all differing types. And I suppose it depends whether you like the physicality of owning a property or whether you're looking just for return, whether you're looking for long-term or whether you want short-term. So there's something for everybody, but if you're having trouble getting finance as a foreigner, the indirect route is still a great passage to participate in the safety of the Australian market without the hassle and the turn down of not getting finance and all those other things. So just having a look overall at where the market is heading and the state of play. Well, basically, we have got a split market going on in Australia. It's very much split between the stops, and the undesirable, and the owner-occupier, wanted stock. You want to be in something that is owner-occupier and desirable. That is the key to success in Australia. That's the market that has the higher demand and the most willing participants and most generous buyers. If you're in the investment only and undesirable market, particularly in those stops, not only do you have less people looking for it, don't forget 30% of the market is investment, 70% owner occupied, but they're usually less willing to be generous on their acquisition. They're saying, what are the investment fundamentals? And I will pay you based on that. Where an owner occupier will come in and go, oh my goodness, I love the view. How much do you want? So if you're looking for that extra kick in performance, you want someone to be chasing you, not just telling you how bad things are. Supply and demand is still the most important thing in the world, not just Australia. And I can't, emphasize enough that you must be in areas at both macro and micro level that have the potential to keep strong demand. And that's the nicer suburbs, the nicer homes, the family size, the larger areas, infrastructure, school districts, many, many different things. Now that's good because if we all had just one wish list, then one area would be dominant and everywhere would be terrible. But whatever it is that you like about a property, try and find that in the property you're buying. I think it's essential that we see migration return to Australia, but it's more that permanent migration that we need. But the students and the travellers will start coming back a bit later. Probably in 6 to 12 months, we'll start to see that, starting to come back, which means we're going to have a quiet time, particularly in those smaller apartments, more suited to students, for another 6 to 12 months. So don't be too keen to jump into that market. But the permanent residents, again, I think Treasurer has got it wrong. I don't think many of the permanent expats that have come back are going to leave anytime soon. So we'll see how that works. And of course, I think, as with all crisis, it does give a period of opportunity. Whilst people aren't sure, you can take advantage. One of the things that I always remind people in Australian property is that it's very different from house to house. We don't tend to have, everything looking the same in a suburb. So you want to be, very careful with your selection. Pick what you're after, whether it's a view, close to a school, nice big living area, open plan, colour of roof, whatever it is. Be wise with your selection and take advantage of the opportunity. Now, of course, right now, opportunity is backed up by an incredibly low holding cost. We've never seen interest rates this low. So if you are going to take a chance on a more expensive, better quality property, you couldn't do it at a better time than when interest rates are at record lows. So if you can get finance, make sure you back it up, get your property. We obviously can assist you with finance, let you know all your options. So give us a call, we'll get you pre-approved. It's very, very important to remember not to go shopping for a property in Australia until you have your finance approved. The reason being is there's no guarantee you will get finance. And if you put a deposit down, assuming you'll get a loan, no problems, and get told no, you might put your deposit at risk. So I would strongly recommend that before you actually go too far into your looking or too far into any purchase, get your finance approved or assessed by a qualified finance broker and get exactly to know what you're up for. And of course, we're in this new age where this fractional ownership or indirect ownership is now commonplace and far more advanced and protected than ever before. So what it does do is if you are unfortunate that you can't get a loan, you're not left to just wish you were a participant. You can take an alternate route and become part of a group, and larger participation, and still get the benefit of access to the market and choose what level of product and liquidity you want and benefit from the strong supported market in Australia that I think is going to have a nice little upkick as people realise how well Australia has been able to manage COVID and how attractive it comes as a living destination if this thing ever comes back. So on that note, I hope that's given you a good insight into the Australian market, and you can take that away with some thought and make some good, wise decisions. And I'll pass back and then see if we can take any questions. Thanks very much for your attention.
All right, thank you, Steve. Okay, now we'll get to the question and answer session. So I'll kick the ball. I'll get the ball rolling. So you mentioned that the relief measures and the support packages by the government only runs for about 6 months. What is going to happen after that support packages are taken away?
Yeah, well, the government announced their budget about 2 weeks ago. They haven't said that they're going to extend many of these programs. So everything seems to have done its job. They don't feel at the moment there is any need to make extensions to a lot of the property market initiatives, but they have already extended things like the JobKeeper program, which meant that if anyone was employed and their boss was struggling, the government's paying a large portion of their salary. And they are constantly watching what's going on. So what I can say to you is that the government has a very, very clear history that if it is needed to come in and help, it does so. And again, that is unusual. There's no other government on the planet that has taken the measures that Australia has to protect the average individual, not necessarily just the business, not the residential, not the corporate, not the guy that's living in that house, both the tenant and the owner-occupier. So I think you can take great comfort that if something is necessary, they will do it.
Okay, now we'll open up to the audience. You can type in your questions in the Q&A box. Maybe another one from me. So how do you think the economic base of Australia has been affected, not only by COVID, but also by the relationships with China?
Well, I suppose, COVID and China, you can't really say them exclusively now. They're basically tied and tied. So, we were seeing Australia, progressing nicely. Australia held the record, many people don't know. We'd gone, I think, 29 years without a recession. That's a world record. No one's ever gone 29 years without a recession. We are now technically in recession, but the government has been very keen to ensure that it's called the COVID recession. So it's not just a normal recession. It's not a general economic downturn. It's caused by COVID. They've gone and spent an enormous amount of money to start the economy. So again, the budget has seen in excess of $500 billion of additional initiatives over the next 5 odd years to keep the economy booming. Infrastructure programs, support programs, employment programs, incredible amounts of money being spent. So I think the economy generally is okay. The government revenues have been able to hold out particularly well considering everything that's gone on. I think, the gross budget, went down only about 20 or $30 billion in expected revenues, over about 470 down to 450. That's remarkable given how much things were physically closed and how much they put out in subsidies. So the Australian economy is extremely resilient, and I think that's going to be seen as a big attraction for anyone looking at where should I live in the future. If you can go down and live in somewhere like Australia that has stability, the ability to isolate, the proper self-management in a crisis, and the care and compassion to ensure everybody is safe and protected from a health and financial perspective, there's nowhere like Australia.
Okay, we got one question. Which states would you recommend a first-time buyer in Australia to focus on?
Yeah, look, I think it's very much down to two things. Number one is preference, which is your favorite state. You should always go to where you like to buy, and also budget. I think the Australian opportunity is fairly consistent. I think, Sydney obviously has been the star performer and may indeed stay that way, although I think it's probably coming towards the end of its cycle. But Sydney people wouldn't agree with me. But the thing with Sydney, though, is that you've got to spend a heck of a lot of money to get a very little property. I think I just sold my 2-bedroom small apartment without a view in Sydney to pay for my penthouse with an amazing city view on the water in Perth, when it was a 3-bedroom rather than a 2-bedroom, and I had change left over. So to me, I think there's great value in the markets in Queensland and WA. I think Victoria probably has, at the moment, the most risk because it's gone from one of the most popular, fastest population growth to now have the worst COVID record. I think that's going to have an impact on sentiment long term. I think people are going to start looking at alternate venues to live, WA, Queensland in particular. So to me, I think you're going to see a little bit of an export of human capital out of Victoria, just because of the way it wasn't as well handled as the rest of the country. And also because the cost there is also quite high, not quite as high as Sydney, but when you look at what you can get in WA and Queensland, great value. So to me, reasonable price, reasonable opportunity. I would probably favour the likes of WA and Queensland right now, but you can't underestimate the financial power of the populations of Sydney and Melbourne. But you just have to be very careful to buy the better areas, because that's going to protect you no matter what happens. If you're in the better areas like a Mosman in Sydney or a Toorak in Melbourne, they're going to give you protection even if the market softens off generally.
Okay, we have one more question. Can you elaborate what would be the exit option for fractional ownership?
Yeah, the good thing with most fractional things is it's clearly stated in the information memorandums. So, most fractional ownership will say that they have either a 5 or a 10-year intention. So, you know, you'll know that it might come to a close and they'll sell the property later on. And also many of the people offer what we call secondary market. So, you know, so even if you want to get out, they would probably have clients that were looking to invest in their next project. So they would, you know, get them to buy your units rather than necessarily do that. So you also want to be with someone that is mindful of that can perhaps look to manage a secondary market on an informal basis. You know, or, you know, like I say, look at the timelines and make sure that they match up with what your intentions are.
Okay, one quick one. Can foreigners buy landed property? I believe the answer is yes for brand new developments, right?
Yeah, a foreigner must buy a brand new property. So you can buy a block of land and build. You can buy an established property only if you guarantee to knock it down and rebuild. So you need to get permission. There's a foreign investor fee and there's stamp duties that are additional. But you certainly can buy it under certain conditions, but you cannot buy an established property to just be an investor. That's what you can't do as a foreigner. It has to have, you know, significant value add or new construction.
Okay, there are a lot of articles on the internet speculating that Australian property prices will fall in the coming years due to border closures as well as slowing population growth. What are your thoughts on the wildly divided speculations on the Australian property market?
Yeah, look, again, I presented a seminar in April, you know, at the height of COVID, you know, everyone was saying, like I say, 20–30% falls were absolutely guaranteed, no doubt at all. I never believed that to be the case then. I don't believe that to be the case now. Again, you know, the border closures is the thing that has kept the market safe because it's kept the health of the community safe. They're going to be opened up when it's prudent to do so, and likely when we see a vaccine. So I cannot imagine Australia, you know, or many places will allow free travel until we see a vaccine readily available that is acceptable and proven. So don't worry about the borders being closed. That's the least of your concerns for the Australian property market. You know, the issue is the population growth, and like I say, I think that is definitely got potential to pause some markets and also decline others. But that's why I've been saying in this presentation that you need to be very mindful of what you buy and where you buy it. You want to be in the areas that aren't affected by population growth as much because they're so desirable. People are wanting them anytime. You know, if you look at the stats across Australia, usually only 5% of all properties in a suburb change hands each year. And what that means is that it can take up to 20 years for that property to come on the market again. So there's usually a fair few people that have been waiting a while for that nice property to come on the market. And you'd be surprised how strong the queue is from the locals. You know, like I say, 70% owner occupied rate, one of the highest, if not the highest in the world. You know, $80,000 average weekly earnings, one of the highest in the world. You know, those things contribute to the fact that borders open, borders closed, COVID here, COVID not, the market stays stable and active, you know, for things of want. Just don't buy stops, don't buy junk, and you'll be fine.
I think that will be the end of the webinar, running out of time. I would like to thank Steve for sharing with us this wonderful presentation on the Australian property market. I believe there are 4 more questions. We'll try to get them answered and send them out to everyone so that you can get the questions answered for you. So with that, I'd like to thank Steve and everyone for attending and have a good day. This is the end of the seminar.
Thanks, everybody. Really appreciate, you know, the chaps at Fraxtor. Good job. See you soon.
Thank you.